don't get so caught up in the actual investment tool or vehicle or trying to outtime everything. It's how does everything work together, and can that help you reach or exceed your goals? That's the win.
It can get overwhelming when you look at these mutual funds, and especially if you dig into some funds that you own, you might not realize how many positions you do have in there.
The problem with mutual funds is not that they exist. The problem is when people assume owning a collection of funds means they have a diversified retirement plan.
Hello and welcome to the Relax It's Retirement podcast with your host, Josh Leonard, where we talk about transitioning into retirement with intent. I'm your producer, Wendy McConnell. Well, hello there, Josh.
Hey, Wendy, how are you?
I'm good. I'm seeing an old friend, somebody I haven't seen in a really long time. This is Pete Belcastro. Did I say that right?
You did. This is the wonderful Peter Belcastro, as his mother might call him.
That's right.
There's got to be a middle name in there, though,
Wendy
right?
thinks. Thanks. I'm sure. I'm sure if she was here, she would definitely agree with you.
Yes. Pete's mother is a wonderful lady. We see how Pete got so many fantastic traits from her. So we are happy to have Pete back on, and Pete on our team has a little bit more in the investment experience too. So while he's a CFP and does a lot of planning for our team too, he has a lot of background in the mutual fund industry too. So I wanted to bring him on here to talk about 5 problems with mutual funds, right? So if someone has some expertise in something, we should totally talk about how bad it is, right, Pete?
Absolutely. Definitely don't want to ignore it. Usually things don't get better when you
ignore them. Exactly. So, Wendy, you ready to pick on mutual funds today?
Oh, I'm always ready to pick on mutual funds.
These are the things you think about over the weekend, right? You're like,
Yes, I can put a lot of thought into it.
Problems with mutual funds. Well, I think before we start picking on something, I think it's important to recognize the need and the existence of the tool. Mutual funds, especially when we first start out investing, are an amazing tool. We can start with a relatively low dollar investment amount and get some broad diversification and really access to maybe some world-class managers as well, right, Pete?
Absolutely. I mean, the name really says it all. Is it's mutual fund, so it's something that mutually, like you and I, a lot of other people with these funds can own together. Where a high stock price might have been maybe a barrier for people to get into the market or into a specific area in the market, if you pull money together, now we can afford and get in those places.
Yeah, I think that's it. I think a mutual fund as a tool helped open investment to many more folks, right? So check, that's a win, right? Now, here's where the problems come into play, right? And our first problem out of the 5 that we'll talk through today is that diversification can be an illusion. Sometimes in mutual funds, we buy multiple mutual funds, right? Maybe we look at a lineup of funds and we see, hey, these 3 have done really well, and we buy those 3 funds. So we might feel that we're diversified because we have 3 different funds, right? Pete, how's that a problem then?
It's well, whenever you start digging into these mutual funds, they'll have different names and often different goals. Kind of like usually our own situations. We want to have a certain goal in mind when we start off. So when we dig into these mutual funds, someone might have, like you said, multiple funds. Maybe it's through multiple different mutual fund companies. You might see different names on there. And then when you dig into them, we end up seeing a lot of different overlap, especially if you're focusing on just the returns of these mutual funds, because you can imagine that if mutual funds have similar returns, well, maybe you might have probably similar holdings in there as well.
That's true. Yeah, I think sometimes we'll pull folks like 401ks, and I think 401ks have gone through this evolution of, hey, it's up to you as the individual to make those wise investment decisions. So we get an expansion of a fund lineup, right? And maybe we have 20 different funds. So people look through, they want the best ones in that lineup. So maybe they pick 5 or 10 of the top ones and put the even percentage across those, right? Why is that a problem?
It's definitely an easy way to kind of look at things. And whenever we do have access to company plans, we do preach that, hey, start that investment. Yes,
Yeah.
it's great. It's an awesome benefit if your company does have these plans available to you, which most do now. We all are aware of that, and whenever we do want to start investing in these products, you might start to see that there's maybe one fund company that uh, I mean, you can imagine if it's one company, maybe these people will actually see each other. Maybe they work together. Maybe they get similar reports, and you can imagine that might lead to maybe similar investments within those. So the main benefit that we see is that you have access to the market. Not necessarily that these might be all of the best options that you have within maybe the investment world.
Yeah. Yeah. I think in particular, you had mentioned too, like maybe they own a large cap equity fund, right? So many times in a 401k, we'll have a passive and an active option. So maybe they own something tracking the S&P 500, and then they also have an active fund that, well, is buying stocks in the S&P 500. So if we purchase both of those in equal weight, we might be owning 90% of the same stuff at two different costs and with two different reasons. So that diversification can become an illusion. We're not really getting the benefits of diversification by just owning the same stuff in two different plans, which I think is a good pivot to our second problem. Our second problem being that mutual funds are not built around your retirement plan, right? A 401k is not a retirement plan. It's a savings vehicle, right?
That's right. That's right. It's just a shell there, and whenever you purchase these investments, or you decide to allocate your money towards different areas within the markets, those managers are just trying to manage within that parameter. So Josh mentions maybe a large cap growth a fund. There's you can imagine mid-sized companies, small companies, but that manager is supposed to be managing within that area. They're not saying, hey, you're retiring next year, or hey, you know what, I'm good in retirement. This money's actually for my kids. They don't know those different goals within that plan. So really, they are just trying to invest to the best of their ability within the sector that they are investing in.
Yeah.
That kind of makes sense.
Well, and I think in that 401k, it is oftentimes, not always, but many times we might have some good low cost options. And due to the scale of that plan, they're low cost, right? But the 401k provider is not going to call you and tell you to do a Roth conversion, right? Even if maybe they supply some educational material around something like a Roth conversion, they don't know all of your income to factor in things like avoiding those income-related Medicare adjustment amounts, right? So the increase in cost of Medicare based on your total income, right? And sometimes those funds, now let's say held outside, could also, as we'll talk about later, create some tax consequences that we don't like to bump it up there. So to us, the investment plan has to match the total plan, right? That's the true intent planning system. So when we think of a fund, it might be a great entry level vehicle, right? We can get in, we can start getting hopefully some great growth of our money, but it's not a plan in and of itself, right? It doesn't have an income plan. It doesn't tell us how we're taking the income out. Certainly doesn't have any tax planning built in. It's not timing out your Social Security or anything like that, right? It is just that sole investment tool.
Absolutely. It's a great tool. I mean, we don't want to diminish the there's a reason why they exist.
Mhm.
And I mean, just imagine, I mean, you're starting off, investing, and we all had to start at one point, and you have $1,000, and you see that, I want to be a diversified portfolio. Let me buy some stock, and Microsoft's over $500. It's like, all right, well, maybe I can have two positions, and oftentimes, with it, yeah, what are the chances that those two positions might go down at the same time? it's more risky, right? So it allows you to have a whole bunch of different companies. So you could own Microsoft, you could own Apple, you could own Amazon, all these names with a smaller amount of money. So and oftentimes we do start investing within company plans. So or that diversification that you get is a great benefit. Once we start and we're further on in investing and we're investing outside of company plans, maybe an individual account or joint account with a spouse, that's whenever we start seeing those mutual funds, maybe some of the things that are not the positive aspects of them start to show their,
Yeah, I think that's a good point. I think in general we want to think of the investments serving the plan, not the investments being their own thing and the plan being its own thing, right? And I think the biggest way that we see this, especially for folks later on in their careers, transitioning into retirement, is sort of in what pivots to our third problem, the tax surprises and loss of control within that tool. So first one that comes to mind, we have a client that started working with us recently. They were late in their career, earning the most money that they ever have, and they've been a good saver. They put money away utilizing mutual funds, high quality mutual funds too, right? They've done well performance-wise over time, but they have some byproducts to them. One of the big ones is capital gains. And for this family, it was generating over $200,000 in capital gains annually. And these are what we refer to as the phantom gains, right? Like he wasn't getting the money in his pocket. He was getting the tax bill, but the money was just being reinvested within the account. So it wasn't ever coming to his pocket, right? And while we want that growth, it's better if it can stay within the account, right?
Yeah. Gains are definitely the goal. I mean, whenever we, I don't know anybody that's come to us and say, "Hey, I'd like to invest this money and come away with a loss."
Yeah.
So, these are part of the, I would say, positive consequences of owning, of investing, and whenever I think frustrations start to happen whenever the expectations are missed, and that is a what really drives that is the unknown, and that's uncomfortable. And if we know what might happen, or we have a little bit of control in that, it really we see a great benefit, especially whenever it comes to retirees later on in life, whenever you are that good saver and you do have that chunk of cash, whenever you have to start paying taxes on these things that you don't need or you don't want, that's a factor that we need to take into account, especially if it's not part of the goal for that fund. Maybe this investment you need to you're not going to use it. Maybe it's for your children.
Yeah.
and it really doesn't benefit you to realize gains at the time.
Yeah, I think we talk to folks all the time about that control. So typically we think of capital gains as, hey, I bought something for one price, I let it grow at least a year and a day, right, to qualify for long-term capital gains. A year and a day later, I decide to sell this thing, and then I pay capital gains. We have full control over that, right? We can choose whether or not to sell the company. Now, if it's a high-quality company and we believe in that company, maybe we never sell it, right? And if we never sell it, then our kids or whoever we pass the money on to gets that step up in basis. So even if we had 90% of that stock value as gain at time of our death, it steps up to that value on day one. That is a huge tax advantage.
Absolutely.
In the mutual funds, we don't have that level of control, right? And those phantom gains that we talk about, that's what we're saying is within that fund, they might have bought Apple stock in 1995. And then not all of us, but most of us have iPhones. That was an Android jab there, Wendy. Did you get that?
Yes, I did.
Anyway,
I'm sticking to it. I'm sticking with it.
But Apple as a company has done really well. Any which way, right? It has become a gigantic company. Within that fund, if they want to reduce their exposure to Apple stock or they need to cover redemptions, they have to sell it. And maybe you haven't owned that fund since 1995, but you still mutually share in whatever that taxable gain is within the account. And that's where people get into problems. Right now, net flows of funds are coming out of mutual funds. People are choosing to invest, again, in individual stocks, a little bit more in ETFs. Many times for that tax efficiency or more control. So as those funds are pouring out of the mutual funds, they have to sell more of that old Apple stock, right? Or NVIDIA or Google, Facebook, Amazon, whatever the company might be, those gains are getting passed through sometimes at a proportionately higher rate.
Yeah. They in mutual funds, whenever we do evaluate these things, we use a variety of different ways to make sure that mutual funds or individual stocks, or companies are working within a plan for somebody. And sometimes whenever those you know th- those mutual funds, they have a long track record, right? We want to say, hey, this is what this managers have done. This is what this fund has done. It has a 10-year track record. It has a 15-year track record. I mean, I know people that have been in mutual funds, for over 25, 30 years. And to have that long track record, most likely they were investing for that long period of time. So, like we said, you have a company that bought Apple, whenever it was, maybe cents or just, a couple bucks. That is doubly true with these mutual funds that most people are invested in because they're the ones with those long track records.
Yeah. And I think unwinding it sometimes can become complicated as well. So people choose to continue ignoring the problem, right? If they sell out of all the funds, they might have even a bigger capital gain. So we want to avoid that. What we find many times is people are reinvesting a lot of the dividends into the same fund again. So they're really continuing to grow the problem when they have a very easy out. If they take, that dividend or the income produced by the portfolio and start to just put it in cash or maybe start to buy ETFs or individual stocks, they are starting to gain control on that slowly. Now, unwinding the whole thing might take a little bit more time, right? We need to set some capital gains budgets. We need to look at those individual share classes that we've bought along the time to try to unwind that. So that's a bit of a project. It's something people like us like doing, but for individual investors, it might be too much.
Yeah, it's definitely it can get overwhelming when you look at these mutual funds, and especially if you dig into the some funds that you own, you might not realize how many positions you do have in there. So yeah, I mean, we definitely see people just accept it as part of life, a part of investing. Whenever I go to see my accountant, before tax day, I get all that stuff, and it lets me know what realized capital gains were, even though I didn't take any income.
Yes, yeah. I didn't get any, but I got to pay taxes on it. So that's a big problem. That's one that we run into a lot. So that number 3, that sort of tax issue and potential loss of control in there. It's a good pivot into 4, which is the true cost of the fund. It's not always obvious, right? Sometimes it's a fund of funds, right? Maybe it's an onion, right? There's a couple layers to it. And also the tax drag.
Yeah, that's right. Oftentimes we do see that whenever people are invested in these mutual funds and you do ignore, those capital gains, oftentimes they're stacking these capital gains on top of other income that they have. And, definitely within, qualified accounts, it's not as big of an issue that we see. But whenever you are that good saver, you have those outside monies, that not only do you end up maybe paying higher percentage on your other income or maybe even those capital gains, but it starts dipping into your Medicare. There's some ramifications whenever your income starts to exceed these IRMA levels that we've talked about before.
Yeah.
So.
Yeah, I think in particular, like when we run a fund report, so you looking at the overlap, the capital gains, I think making sure we understand what the expense ratio of the fund is as well is a really big one. Sometimes we'll run through and people say, oh, I don't want to hire a financial advisor because they're expensive. And then you look through all their funds and you're like, well, you pretty much are already paying a financial advisor. You just haven't met them yet, right? You're paying the fund manager. Sometimes those can be really high fees. So being mindful of that. I think one of the more hidden fees in there can be that tax drag. like through our TMS solutions, through our partners at AssetMark, we can see, hey, if we had that tax drag on the portfolio, it would make, on average, they say 1.2% difference. If we're in a fund where we don't have those sort of options to control that tax, it could be lowering our return net, the actual amount we get in our pocket, by more than 1% a year. That's a pretty big number.
It is. Yeah. I mean, that does compound, and it it makes a difference. It sure does. That tax drag piece that, I mean, unless you really dig into it and um, you do the proper analysis, it's really hard to see. It's not obvious, and it's not that I think that these things are trying to be deceitful or not tell people exactly what the return might be. It's just the nature of the product. It's just what you have to do to be able to have this, these amount of positions, to have a manager, to do distributions, to do all the things.
Yeah, absolutely. And I think that's it. There's always a cost. So just need to be aware of the cost, right? And not be assuming that there's no cost to things, right? No such thing as free lunch, right? I think the other thing that we find in looking at those funds is sometimes the higher turnover funds too. There's a cost to that. Sometimes there's issues sort of classically in mutual funds of like this window dressing of like, well, we didn't do all that great over the last quarter, but if we put NVIDIA and Amazon and Facebook at the top of the list here at the end, it'll look like we're going to be better moving forward, right? So they sell things out really quickly. That high turnover has a cost to it too, right? So we want to keep an eye out for those kind of things, right? If we need to use it, if maybe it's in our 401k lineup or something and that's our only choice, let's be mindful of those internal expenses. At the end of the day, if we can get the exact same management for a slightly lower cost, it's going to put more money in our pockets.
Absolutely. I think focusing on your goals and, once you see, where you want to go, what your expectations are, it makes it a lot easier to look at some of these investments and say, what is the true return that I actually need? If it looks like this fund is meeting that, and you kind of dig into it, and there might be a tax issue later, wouldn't that be nice to know ahead of time? A few years ago, so that return that you think you're actually might get, or maybe it's part of your plan, and you think it's gonna, make you reach that goal, you might fall short, and that's not, obviously something that we want to experience for somebody, in retirement.
Sure.
Yeah,
Yeah, I think we talk about being proactive a lot, and I think when we think through our asset allocation, we also need to think through our asset location. So a lot of the issues that we've been talking about, especially around taxability, are only if these funds are held in a taxable account. So maybe you have a mutual fund that you've loved forever and you really want to keep a piece of that. It's been causing you a tax problem in your taxable account, but you have an IRA sitting there that you could, or a Roth IRA, and we could purchase it in there and not have that same tax friction within it. So that's kind of the location. Now, if this is a aggressive growth mutual fund, maybe we don't want to put it in that money that we're going to start withdrawing for our retirement income in a year or two, right? We need to think of that location, the timeline, always being appropriate there.
Yeah, I mean, working through our buckets, we definitely, whenever you look at the cash, the income, the growth, where you have these things and you have you have an account that is creating capital gains and you're using it for income and maybe that's the wrong bucket to have this in. We might need to take a look and see, is that better to be something that's deferred?
Yeah.
Or maybe it's something that the fluctuations within there are creating more of a tax drag than the income that it's creating. So it's a huge piece. I mean, everybody knows, what are the whenever you have a business, what are the three best things, right? Location, location, location. So, it's important within your own investments as well.
Certainly so. I think we'll bring it around here to number 5, Pete, which is the return you see is not always the return that you get, right? Morningstar's put out this study, and we were just talking about it prior to the recording. The one that we're going to cite today is the 2025, but it's the Mind the Gap study. And what they're looking at here is the difference between fund returns and investor returns, right? So there's a gap there, and we want to be mindful of the gap, hence the name of the study. It's a 1.2% difference there.
It is. That's the average too.
Yes.
So, I mean, keep in mind that there are some funds that you might see some really, really great returns. Maybe something that's outside of the norm. Maybe something that you think is too good to be true. Maybe it is. You start digging into it and you see that, wow, the real return might be a little bit different than what we expect. Yeah.
Well, and I think
different is better. Yeah.
Outside of like that tax drag that we talked about, I mean, there's also just the investor behavior, right? I think COVID just really highlighted so much of this for me, right? We could have all become billionaires by investing in movie theaters again, right? And video game stores, right? Because certainly people don't buy those things online and stream movies these days. Never, right? These sort of like cult buy-ins of individual stocks sometimes can create a high level of optimism, right? The same thing can happen with funds, right? We look and say, hey, Pete's mutual fund has done really, really well the last 3 years. I'm going to buy it now. And then it starts to decline. And then you think, hey, maybe Pete's mutual fund isn't that good. And we tend to sell out and then it rebounds, right? So our investor behavior can often drag down the return as well. I think a lot of times that is to clients, it's often hard to calculate the benefit of working with an advisor to help combat our natural behavior, right? If we're losing money, we want to stop doing what is causing us to lose money. That's natural, right? By sticking with a plan, we can get those long-term average returns or get a lot closer to it. If we're not doing the behavior part, then we're certainly not going to succeed.
The plan, usually when we first sit down with somebody and we say, "Hey, here's where we go," that's when the planning starts. And it's not whenever the planning ends. So whenever we say, "Hey, this is where we see you, this is where we want in 5, 10, 15, 20, 25, here's how your legacy is going to look," that's when the planning starts. That's not, hey, set in stone. I think that is very important to make sure that it's on top of mind to people.
Yeah.
These things are going to change. And, if something worked for us for a long while, it might not help us achieve our plan in the end, whether it's too volatile or the cost is too much, or it's going to bump us into another tax bracket, in the future. Or maybe it's my kids aren't going to inherit as much as I thought. I got 4 kids, and all of a sudden I see Uncle Sam's, a third beneficiary.
So you got 2 more on the way, Pete.
No.
No, those are dogs. Dogs aren't good to inherit money. Sorry, I threw you off there, Pete. But I think it's true. I think today we're talking about mutual funds. And while we're talking about some of the negatives of them, a lot of them come into play just with general investing, right? And we shouldn't be in love with the investment. We should be in love with the result of the investment, right? We invest to make more money, right? We take on risk to hopefully get a reward. I think through our planning, through the TIPS planning system, what we get to celebrate in the office is when a client comes and they finally feel ready to spend a little bit more in retirement, or actually retire a year or 2 earlier, or be able to spend more time with their family, right? These are sort of the intangible parts of what that fund might or might not be doing for us. So we need to align our investments with our total plan. A mutual fund is a tool in an investment plan that's one of 5 pillars of that retirement plan.
Yeah. I've never sat there in a client meeting and celebrated with somebody and brought them to tears because they got 15% return that year. It just wasn't, where I see the celebrations and we see those tears whenever somebody realized they can stay in maybe an assisted living facility they didn't think they were able to, it had nothing to do with the returns. So I think that, keeping that in mind, that even though, gosh, we want to chase, maybe your neighbor told you that they got, 30% return or 20% return, or we have these things, ultimately, you're not going to celebrate that. We're going to celebrate being able to buy that muscle car that we wanted when we were a child, or we can take our entire family on a vacation that we didn't think was possible. Those are the things that that drive our decisions, that are goals that we like to set.
Yeah. I like that. I know that client situation you were referencing was a big one for you recently. I think we get to see a lot of these different versions of these wins for planning, right? Don't get so caught up in the actual investment tool or vehicle or trying to outtime everything. It's how does everything work together, and can that help you reach or exceed your goals? That's the win, right? Well, Pete, thanks a lot for joining in today. Wendy, always a pleasure having you. I know we got a little into funds, and I know that you wanted to add a lot more.
Well, funds are fun for me. So but next time.
Okay, next time.
Okay.
Well, I certainly appreciate that, Wendy. Wendy, as always, it was a pleasure having you. Thanks again for joining. And to all of our listeners, until next time, remember to retire with intent so you can live your golden years with the happiness and excitement you deserve.